This is Rod Kusin and Spooman for Risk. Today's date is September 13th, 2009. This is the third in a series of videos on the future market crash of 2009. Today's video focuses on the commitments of traders. This is an actual report that comes out of the Commodity Futures Trading Commission every week. It shows us how both commercial and non-commercial traders are responding to the market. It will tell us what percentage of these traders and the actual number of traders are taking long positions versus short positions in the market. The significance of this report has to do with the pattern that has long been established that short trading precedes a market correction. We can actually tell whether this is happening based upon this report. When you go to the CFTC website and the commitment of traders, all you need to do is move down to the futures only and futures and options combined portion of the report. Today we're just going to look at the short format of the CME. And we'll move down particularly to the S&P 500 large contract. This report as of September the 8th shows both the non-commercial and commercial positions. In both instances on the large contract, the number of short traders is now greater than the number of long traders. On the E-mini, that position has not yet quite taken place with non-commercial traders. But commercial traders, there are more short traders now than there are long traders. You will soon begin to see non-commercial traders catch up with the big boys. A graph of the same shows us a little more detail over an extended period of time. This graph separates the commitments of traders into three categories: large speculators, small speculators, and the commercial market, where blue bars represent the large speculators and red bars the commercial market. In March, toward the end of March, or pardon me, towards the middle to the end of March, you could see how large speculators were no longer shorting the market and went long. But toward the middle of June, just the opposite took place. Large speculators have been shorting the market ever since the middle of June. At the bottom of this report, it shows the change that has been taking place since the beginning of August. Large speculators are now less bullish than they were in the past. Only 40% were bullish in the early part of August, whereas now in the early part of September, 39% are still bullish. In other words, better than 60% of large speculators are now shorting the market. And on the commercial side, 52% are shorting the market. The point of the matter, once again, short selling precedes a market correction. And that's exactly what we see going on here, and that short selling is now on the increase. Let's take a look at some of the technical reasons why we see this happening. This is a graph of the weekly E-mini S&P 500 futures. The E-mini S&P 500 being plotted here and the technical indicator that we have surrounding it is an adaptive price zone. Here we have a slow stochastic, and finally a relative strength indicator. It is generally understood that when the highs of the market finally reach the upper two bands, the market is in an overbought condition. The adaptive price zone shows us this. The slow stochastic is now also in an overbought condition, as well as the RSI. These market indicators are telling us that we're poised, ready to go down. And you'll notice that on the weekly chart, as we expand this on the stochastic is already turned. The RSI, although it is currently pointing up, is still in an overbought condition, ready to move down. We see the same thing when we change over to a daily chart. On a daily chart, again, the S&P is in the upper bands of the adaptive price zone. The stochastic, while it is not yet turned, again is in an overbought condition, as is the RSI. So it is of little wonder to us that short selling has now begun to enter into the market, which is exactly what we would expect prior to a significant market correction. So there we have it. The commitment of traders indicates that we're poised, ready to go down. The adaptive price zone, the slow stochastic, the RSI, they're all in overbought conditions. So in the light of this, we once again provide this warning. This market is ready to go down. And based upon the information that we have already examined from the VIX and the Baltic Dry Index, everything suggests that this correction is going to be significant. So take appropriate action. If you are already in profits, make sure you protect them. This is Rod Kusanen, Spooman for Risk.